Hey,
Hello, hello, hello.
how you doing, Marcello?
Pretty much well. What about you, buddy?
I'm good. Bitcoin is going up. I'm a happy man.
I know
The
you.
team.
Good.
I'm so happy, man. I think maybe I don't know. Maybe I'll fly out to Vegas this weekend.
Finally, we can get to
You
do
want to
some
join
fun
me? Can you join me?
in Vegas. Of course, I got a free flights. I don't know how long
All right.
for, but
All
I
right.
can
Listen. Let's
try.
let's get let's get down to business. Let's talk to the people. What are we talking about today? What are we talking today
So
about on
we
breaking banks?
um, we actually, like are following our previous, let's say, episodes. We're always talking about like uh, building a portfolio, and we imagine like different kind of situation based on the client's um, risk tolerance. And this time we were talking about like an old man with a lot of money from Texas, Mr. McDonald, and that he might be able to, or he might like stability since he has work is butt off for like many years. Has built like his own business, and he wants to like now retire. And he say, "Yeah, you know, I put so much money away, and I want to enjoy it now. With no, I don't want to get crazy. I want to just try to, enjoy it without like no big risk." And
Right.
it comes to you, it comes to us, and it as a, let's say, supposedly financial advisor, which we are not. We are not trying to pushing anything or like suggesting anything. We are just hypothetically, based on our experience in the financial business, we want to try to you know think like we were him, what we'll have done. And we hypothesize that he might have like bonds or like anything related to the bonds word. But
Yeah.
what the hell is a bond? Do you know what a bond is?
Dude, I wanted to ask you because honestly, I only know what crypto is. Like, I'm not very sophisticated. People who invest or trade crypto. Like, as you know, you did work with me for a short time. I'm really not that smart. I'm kind of, just
It's not true.
I just I'm trading these like Litecoins and these Bitcoins and all these weird things.
My
I
baby.
actually yeah. So, I mean, I have a vague idea of what a bond is, but actually, the concept of a bond always, I majored in economics in university. And actually, when studying bonds, it was really confusing to me because I didn't really understand them. And I didn't understand the relation between bonds and interest rates and like maturity dates and all that stuff. So, yeah, can you like break it down for me? Like, what, like,
Okay, let's
I know the concept, but explain it. Maybe people
you know
don't
i
know what is a
I'm
bond.
not from this country, so my English is not like no my ultimate strength. So let's just Google it. Let's see what Investopedia is gonna say. Okay, what is a bond? Bonds are financial instrument that investor buy to earn interest. Essentially, buying a bond means lending money to the issuer, which could be a company or government entity. The bond has a predetermined maturity and specified interest rate. The issuer commits to repaying the principal. So what the hell it means? It just means that how a mortgage or a loan is, right? Everybody knows. Is
Yeah.
essentially the same thing, but it's a reverse. So it's actually like the government, the bank, any corporation. Usually,
Mhm.
like bonds are issued by big corporation because they can actually like be able to pay back the money plus the interest.
Mhm.
When you are like a small like a small company, a startup, usually um, it's an opposite. Like they like usually they renounce, they give up their own equity. So that's why like angel, they call it angel investor or private equity company. Try like the Shark Tank.
Mhm.
Shark Tank does that.
Yeah.
They are like private equities or little like small investor. they want to get into like small company to grow, and the growth could be potentially enormous, right? Big, but they put for them a small amount of money. This is actually the opposite. Is when like the startup became Apple or Microsoft or Netflix or Tesla, right? It is already big, but they actually don't want to give up their own equity because they're not crazy. I'm not gonna like just like give you more shares. I'm already like
Right.
listed, so I'm not gonna issue more. I will ask for money as a like as I'm I need I want to borrow money from you,
Mm-hmm.
right? And because they are so big, the liquidity they ask, it's it's okay for them to ask for it because they when you go, like I said, when you go to buy a car, the actual um, you know uh, the actual um, underwriter that is gonna ask you the question, oh, what's your income, what's your household like income, what's your like total asset. So when they're gonna do through all this because they're gonna ask, let's say, JP Morgan to say, hey, I want to issue a bond
Mm-hmm.
into the market. And why is that? It's because probably it's gonna cost less for them than ask, or is they're gonna be already like let's say full of debt with some banks.
Mm-hmm.
Like I said, when you are so big, you probably have already like loans and mortgages with mostly
Right.
of the banks. So and
So let me
banks
ask you a quick
themselves
question.
cannot expose themselves.
Yeah. Can I ask you a quick question?
Yeah.
So, when people are organizing a portfolio, let's say they do, what's the traditional model, 60% equity, 40% bonds or whatever.
Yes.
Those bonds, are they like corporate bonds? Are they government bonds? Is it a mix? Like, how does it work?
Well, it can be a little bit of everything. Yeah.
Okay.
Like, but it's actually based on the rating, which was the next step I was
Ah.
trying to introduce. So when you issue a bond, okay, they it's like I said, it's like you asking, um, an actual like an actual loan to your like to your bank for a car
Mhm.
based on your like stability, based on the internal rating they have of you. They will give you like an interest rate because you're
Okay.
qualified, right? So you're a good client. They will give you, okay, you can have a loan for like 4%. If you're a bad creditor, instead of 3 and 4%, they're gonna like charge you 7%, right?
Mhm.
And it's the same works when they issue bonds. It's the same exact thing. So, but because they are like corporation and they're listed on the market, and we're talking about a lot of money and regulation.
Mhm.
So they actually are under reviewing every year, every quarter, I guess, um, from the rating agency, which is Standard and Poor, Moody's, Fitch, and based on the quality or their assets and their production, they will say, okay, yeah, JP Morgan, you're good, you have double A, triple
Mhm.
A. That means that if you go ask for money outside because you need it for any reason, you can need because you want to expand your program, you want to like do something else, you want to like, sometimes they give it for like sponsorize some program that in the future is going to give money, or they're just asking money to do it, to actually like form a private equity that is going to invest in startup, but they know
Mhm.
that their penetration is going to be good, so they repay anyway. For any reason they need the money. It's like you want to buy the
Right.
car,
Yeah.
so that the rating agency is going to like give you the range of how good
Mhm.
you are, and the bank or the market is going to say, okay, yeah, this is a good
Interesting.
rating. So
Now,
based on that, we'll suggest you, because it's not that they decide what the interest rate is going
yeah.
to be. Say, okay, based on your current rating and the much money that you are like asking for, and the kind of um,
Mhm.
bond you're issuing, you should like, say that you can give back 4%.
Right.
Okay, so they're gonna issue, let's say, 100 million US dollars. I think recently, not recently, like a couple of years ago, I wouldn't remember if it was Apple or Netflix who issue like a bond, and everybody wanted to like buy it, even
Hmm.
because he, Netflix was very liquid at that time, and so, and for sure, like there was no problem that they could repair, and that the interest rate was good too.
Hmm.
So that's that's a that's how like a bond works. And so at the other side, I am the investor, right? Who wants to buy?
Hmm.
So how do I pick it up? Let's go back to my Fineco account, and which
Okay.
is very useful. I'll share with you guys, and I'll show you how can we do a research. Okay, so this is like the bond research on Fineco, that which is like the let's say the asset management I use, the broker I use. So
Hmm.
you can filter by everything. Okay,
And
let's
essentially,
say that,
Fineco is very similar. It's like Morningstar, is just the Italian
yeah, in this
version.
case,
Yeah.
this
Yeah.
program works like Morningstar. Yes.
Okay. Gotcha.
So let's say that you want to trade in dollars. Okay, you want to have an annual return of at least 6 to 9%, and then I will explain what it is.
Okay.
Then I'll add and remove coupon. So the coupon is gonna be 6 to 9, and then I'll add even another thing, which is the rating we just talked about, and let's see if there is anything available. Okay, perfect. So basically, based on this research that I did, I guess it's Colombia, this one, and this is Ecopetrol, this Ford Motor. So what did I do? I did basically a research based on the currency, because I want dollars. Red annual return, I try to set up for like the highest. It means is the actual like money that I will get back every year. Okay,
Hmm.
net from the taxes. And coupon is actually like the interest rate we were just talking about. So how much money is gonna be the actual, interest rate I will have to, like the issuer is gonna pay me, what we were talking about, like the interest rate on the card based on your rating, right?
Hmm.
So let's say this first one. Okay, let's open it up and then we'll see it. So it's a Colombia.
So this is a
I
government bond of
It's
Colombia, I
a
guess.
Colombia, yeah. I believe
Okay.
this is like the 41 is gonna be the, like 18 January 41 is gonna be the maturity date, so when it's gonna expire, and 6.125 is the actual rate.
Hmm.
Okay, annual coupon, and like we said, the actual issue rating is a triple B.
So that's
You
not
have
that
to,
good, or is that okay?
well, actually, mm, rating wise, from triple B minus up
Hmm.
to triple A, as a financial investor and a financial institution, which is mostly like, the pension funds, okay, when they actually buy the, the bonds for the, and pension fund here in the US are huge, right?
Yeah.
For 1K, everybody. So, and they try to make money, and they usually buy bonds, but they cannot buy bonds if they are not investment grade company. This is an investment grade, so from level triple B minus up to triple A, okay, which is
Hmm.
like the highest secure good company, you can buy everything inside. Okay, but how you buy it? usually you try to get the best interest, the annual return. That's why you filter by annual return. But
Right.
still, you can have a triple B minus. So you could actually buy this. The pension fund can actually buy this, okay?
Mm-hmm.
Because it's investment grade, and because I believe it's in dollars, and it's a really good, uh, it's a really good net return. So
Mm-hmm.
now we're going to introduce another big concept that is kind of hard to understand because it's a little bit of math, but I will try to explain. So basically, if you issue today a new bond, okay, now, okay, for $1 million, one
Mm-hmm.
billion dollars, with a maturity date of like 10 years. So let's take in consideration the treasury bond. So the government, the
Yeah.
United States government issue now a 10-year new treasury.
Yes.
So the current, the new, um, the this new like issuance is gonna like have basically the same interest rate that are current on the same interest curve for the same year. What does it mean? They're already like bonds listing, right? And they have their own return. This
Right.
return is based on their price, okay, and their rating, okay. So their rating means that, like we said, when the B issued at that time, based on their rating, they said, okay, the market condition now it's this, and I'm gonna like issue a new bond at 5%. But let's say that the market condition change, and now after 5 years, that same bond, because the interest rate are higher, the
Mm-hmm.
price goes down
Mm.
because it's an equation.
Yeah. So
Okay.
that's what's actually confusing to me, even as a, I guess you can consider me a, a financial professional. I don't like that's so confusing to me. Like, what makes bond prices go up or down, and what's the relation between
Okay. First of
bond
all, it's the
prices
kind
and
of
interest
bond.
rate?
It's the
Yeah.
kind of bond. So the normal bond is a fixed rate, right? So they tell you, as long, like I said, today I issue a new bond, and the market, I'm gonna like issue a like 8% coupon. So the coupon is what you receive as investor every year, every 6 months, every month.
Hmm.
It depends on the contract. Okay.
Right.
And and then why do you decide it's 8%? It's because you gotta look at the um, interest rate curve currently. You can Google it, you know, and it's basically based on the same instrument. So they will see
Hmm.
the current treasury bond, uh, and how much is traded, and why it's traded differently from the issue, because they always issue like a $100. Okay, why it goes down to 98? Because the market condition, let's say during COVID,
Hmm.
market condition like suggests that probably there is like, and you got to understand who is issuing. So the US government. So US government during COVID for sure had to had like it was like it had to take care of like some extra problem,
Yeah.
printing money, whatever, that will probably like, and that's what happened because I think Moody's or Standard and Poor decreased to
Mm.
AAA plus the US recently. We have from our general manager a question: if I
Mhm.
were to buy bonds at a higher interest rate like now, then hold them for when the rates come down, will my bond be worth more or less? It's going to be worth way more, because you are buying at the current rate. okay, you're gonna, and it still depends what you're buying. So if you're buying like a new one or an older one, if you're buying something already in the market listed, for sure the price is reflecting the current condition based on the coupon that they issue at that time. So let's say that they issue at 5%, but now the market, that the current like expiry, like maturity for the interest curve is like higher. It means that you need to compensate with the price. So the price has to go down in order to understand that the current market situation is like you need to give like 3% more of return, but you're just giving 5% when you issue it, right?
Mm-hmm.
So how that they compensate, the price goes down 3%. Okay, so that covers the 8% that is actually the market condition. That's why, like, when it's if you buy now a bond at this current, assuming that it's not gonna go down again, you're buying it to a price that is like lower than before, than when it's issued. And and that's why it's important, even the coupon. That's why I put the
Mm.
coupon as well, because probably, like the best it will be that you buy. My current fundamental analysis has interest rates being lower in 2-3 years. So would a smart play to be load up on bonds currently? Yes, exactly. Yes, a strong yes. So what I was trying to explain is this one, that
Mm.
the current price are lower because the interest for a fixed interest rate bond,
Right.
because the fixed interest rate bond is a structure like, you once it's issued, you know it pays 5%, let's say, because that current market condition give allowed you to give back a 5%. If the market condition during the years change and the interest rate goes up, what
Mm-hmm.
does it mean? It's not that you have a fixed rate. This doesn't change. What does it change is the price. It has to go down to allow you to have the same return of the current situation.
Right.
Is it a little bit more clear now or not?
Man,
You
like,
imagine it's an equation where the interest rate doesn't change. Okay, I'll try to see if I can explain you with old paper and pen,
please,
right?
please, Mr. Professor Marcello,
Okay, yeah.
Professor
So
Cremi,
this is
please.
price market is equal, let's say, the whatever, 1 plus 1 time 1 plus interest rate. Well, I think I would love to. I understand the concept. I'm struggling to wrap my head around the profit and loss capabilities and calculation.
Yeah, me.
Well,
See,
capabilities and
that's the same with
well,
me. That's why I never got involved in the bond market. I never traded bonds. Like, I
so
never traded
basically, like when
treasury
you buy
yields. Like I don't.
the
It's too
the
much.
profit and
It's
loss,
too.
it's
Yeah.
basically based on the price because
Mm-hmm.
it's traded. Is actually traded.
Right.
Okay, so if you and we are just talking about the fixed, because we talked about the floatable, which is determined through supply and demand. Yes, that's what I was trying to say. The supply and demand, it's based on the current interest rate condition. When you issue it at like 5% and the market and the interest rate market goes up because the government, the Fed, decide to decrease the amount of money that was issued, okay, the interest rate goes up, but you still have a fixed rate. So what does it mean? That price that you purchase your at the issue date is gonna go down
Mm-hmm.
in order to reflect the market condition. You have a worse
So,
rate in the market, which means people don't want it,
right.
right? Because it's a market condition. It right.
So,
So
Mar-
and
Marcel,
this is
can
like
we
a,
do?
yeah.
Sorry, I don't want to interrupt you, but can we do like a real life example? So I know today I randomly stumbled across the ticker. TLT, which is the, I think it's the iShares 20-year bond ETF,
Mhm.
and it went up 2%, which I'm not too familiar with the bond market,
Okay,
but I know that's a pretty significant move. Why did TLT, the ETF, why did it go up 2% today?
the TLT, what is that? Let me
It's
see.
the Yes, the iShares 20-year bond
Okay.
ETF. Yeah, right
Okay,
there.
this is like another concept.
Mm-hmm.
Okay, ETF and funds are built differently.
Mm,
Okay, and they majorly deflect. It's like buying like a variable, a floatable. So it's just based on the rate.
okay.
So what it means, okay, this is like a little bit harder to understand. If you haven't understand very well how does it work, the bond. So basically, like what they do, okay, because an ETF is built on the current or the current listed price. So the current
Mm-hmm.
price, like what our general manager was asking. So the actual market condition, okay, if the interest rate goes up, the ETF goes down because
Mm-hmm.
it reflects the price of the 20-year. So it actually it reflects like just the price. Okay, it's like you're buying just the price of the treasury. You are not getting any coupon. So
Mm-hmm.
that doesn't like include any coupon you're gonna get,
I see.
because like if you buy the bond, you pay 100 and you get back 100. So you can wait
Mm-hmm.
20 years and get, even if it goes up and down the price, you don't care. You just keep it.
So buying the bond, that's different from buying the ETF.
Absolutely, yes.
Oh
Absolutely, yes.
man, so
It's
I'm learning,
completely
so
the opposite.
because that's what always puzzled me, and I'm so happy we're having this discussion because that's what confused me.
So
Like, why is this
okay,
ETF
so
going up?
AUS interest rate is 4.35. I'm just reading the comment. I expect them to be at 2% in 3 years. So I will buy 5-year bonds to reset at 2%. The profit potential is based on what people are willing to pay for a 40/30 rather than the two bonds. So you can buy like, if you expect that the interest rate are going down, the the older the oldest, so that the bond that has the longest maturity is going to have the most reflection of this change. Yeah, the 30 years. You don't need to buy the 5 years. The 5 years is going to change little. The 30 years is going to change a lot
Hmm.
on the price. We're talking about the price, which is the same thing that we are seeing on the ETF. Okay. The good thing that about just the bonds is that if you just look at the price, showed up 90% in November. Yes, because the longer they are, the more they reflect that the price. So let's say that if that's the interest rate curve right there. So that, otherwise, like, if basically, like, the difference on the maturity dates is gonna be due to the fact that how much time is gonna take me to have my money back. It's like a mortgage. If you repay a mortgage in 10 years, it's one interest rate and one risk. If
Hmm.
you want to repay your asset in 30 years, it's going to be more risky. That's why, like, the interests are way different, right? Because it's a way bigger risk repay a debt in triple of the time than in 10 years. So
Wow.
if you know, like, if you're convinced that the interest rate are gonna going down very soon, if you buy like the long, like a 30-year, is going to reflect more exponentially on the price. But that's the thing that we need to understand. This is just talking about the price. When I make that selection earlier, I even introduced the coupon, because even the coupon is going to base, actually, is part of the of this equation. And the
Hmm.
bigger it is, them more as the influential. Okay, so and then it's gonna be a little bit complicated. So like
Yeah, I
let's
have. That's been such a great discussion. Unfortunately, we're nearing the end of our time here, but I
okay.
think we need to have like a part two because I have so many questions
Yeah,
now. Like,
I will have a part two, and we'll
yeah,
try to like disclose it better, like point my. That's last time I said that it is gonna be very interesting, and I wanted to do just an introductory
hmm
episode last time to prepare, because this is gonna be these are like a lot of like concept and
yeah,
mathematicals, and so I will try to show, okay, better and clarify better
yeah.
what
Because I want to ask you in the next episode, how does this relate to like treasury yields? Like we know that like the yield curve has been inverted. What exactly does that mean? Was it
That's
inverted
another
yield
thing.
curve?
Yeah, that's like happened
Yeah,
when.
like
Okay, yeah, we'll talk about
oh
it
wait,
next time.
we'll talk about that next week, and
Okay.
I want to talk about like what does it mean when the bond is at a premium or at a discount, and how does this all relate to like the
Yeah,
stock
the
market and
bond
how
word is
can
like is a
like
known word, so it's like
man,
it's
yeah,
really important that you know, and that's the thing. Like it's the most fundamental like asset class in the world, because the bonds are like I said, like are the base of the pension fund, which is like the
right,
main fund in the world. So like the biggest like funds, BlackRock, Vanguard, um, the Norwegian pension
hmm
fund, like China pension fund, because they treat the money of the pension of the people. They can get crazy. They can just like buy
right.
cryptos. Okay,
Oh
and
man,
that's why I wanted to no, it, try to understand, like
yeah,
they need to have like stability, because
yeah,
their money coming in and then to roll over again, but
hmm
and they need to be sure that this money is going to pay back when people go retired,
Well, I was
right?
hoping that
So
the Italian bank was gonna buy some Bitcoin so I can be rich and retire, but you're telling me they're not
okay,
gonna
so
do that.
I want to add bonds to my portfolio. I already do the fundamental analysis, just need to understand it clearer. Yeah, next time
So
I will disclose even more, because it's a lot for shooting 30
yeah,
minutes. Like it's a lot of concept, and they need to be like. I had a
'cause
major in the financial market, so and bonds was like probably like at 3 months of the
yeah,
time of the class. So
yeah, similar to
it
me,
takes a little bit of.
I took a finance class, like, bonds was like a multi-lecture series, so
Yeah,
we
it's
can't
it's
just
pretty much,
we
but
can't
it's
just
really
break
interesting
it down.
because it's
Yeah,
it's another word, especially like for retirement, thinking about the
mhm.
future. It's a good, it's the most used instrument, so it's good to understand it.
Alright, awesome. Well, so let's, like, dive a lot deeper in the next episode. We'll
Yes,
talk about some of the more advanced concepts when it comes to bonds, like treasury yields and bond premiums, bond discounts.
definitely.
It's gonna be really exciting, really informative. I'm gonna learn a lot because I know nothing about this topic. Marcello's the master of bonds. I'm the master of crypto.
And
So,
don't
we'll
exaggerate.
we'll see you guys, next week. Thanks for tuning in.
Okay.
Click the